ndabona hamaze kujyaho umunyeshuri umwe gusa.
Okay, reka tube dutegereje nka 5 minutes turebe.
Hello there, I'm trying to join. Can you hear me?
Yeah, I can hear you.
Yes, I'm trying to join from another device, an iPad.
Okay.
But I'm not successful. So I'm putting my registration number and I'm repeating the same process I did to join for this computer.
Yeah,
but
sure.
It's not going through.
Oh, because let me see, we have.
So I know it's, so what I think, it's telling me that the registration has expired or something like that.
Can you try again?
Sorry?
Can you try again? Because there was some restriction that we have put in.
Yeah, it seems I cannot register on 2 different devices. Is that correct?
Yeah, but you can try again and see, because I've changed.
Okay.
Is it working?
I'm putting some numbers here. Okay. Yes, yeah, it's working.
Okay.
Thank you.
You're welcome. So you can start. I think now we have 6 students on. Yeah.
So I'm trying to talk. Tell me if there are echoes or if I'm repeating myself. Can you hear me? Can you hear me?
Yes, I'm hearing you.
Are there
so
echoes?
We can start?
Are there echoes or the sound is fine?
No, the sound is fine.
Okay. Okay, so yeah, I think we can start. Are you able to see my presentation?
Yes. Good morning, everyone. In this webinar, this is Strategic Corporate Finance Exam Revision. So this come in response to situation of corona pandemic due to the student failing to attend some tutors. ICPA, in response to that, engage and partner with experienced tutor to facilitate on exam preparation. This is not class as such. It is revision and exam tips for able student to pass exam. We are together with the Deogratias Tushimo Mochiza, which is an ACCA graduate in a good standing. So my name is Nyirinde Kwestratu. I'm moderator and principal examiner of ICPAD. Deogratias, floor is yours for presentation.
Yeah, thank you very much. Just give me a minute.
Okay.
Good morning, everyone. Good morning.
Good morning.
Are there students? Please let me know if you can hear me. Yes, you can either put in the chat, you can write something in the chat. And if you can hear me correctly, please let me know. So, okay, good. I see that you can hear me. So I'm going to put the video for a second so that you can see who you are talking to.
Okay.
Is my video coming?
Yes.
Okay. Good. So then I'll stop the video for a while so that the connectivity can be better. Yeah, good. So thank you, Stratton, for introducing me. There's nothing else I will add on that introduction. I'm here to help the revision for this very important course. Stratton, let me know anytime you can. I'm not able to speak loudly, or if people cannot hear me, please jump in and let me know. So we have about 3 hours, and while I'm talking, you can put in the chat the questions. I will take time to look at the questions and try to respond. Or after 1 hour, I will pause for like 5 minutes to see if there are questions. You can speak directly or so. While I'm talking, you can note down the questions. And I don't know whether there is a possibility for me to share the presentation with the participants so that they can download it. Is that possible, Strato?
Yeah. Yes, it's possible.
Is there a link where you can send the presentation?
So I have this presentation. After this, I will share to all participants.
Okay, very good. So we have about 3 hours to go through the key topics of this very interesting course at the Strategy Corporate Finance. And here is what we are going to cover. So briefly, we look at the exam structure of this paper, and we look at the best practice of the time management. And then second, we make a quick analysis of past papers by examining or looking at the most recurring exam topics. And then we'll go quickly through each topic and see what would be the best way to tackle any question in the exam that is coming from any of those topics. So this is how the exam is structured. This exam has 3 questions. The first question is generally a compulsory questions marked out of 50. Then you have 3 questions out of which you have to select 2. In total, making 3 questions. And each of the 3 questions is marked out of 25. So in total, it's 100. Now, the best way to success to this exam is to make sure that you complete all the requirements. You've attempted all the questions. That should be goal number 1. So priority number 1 is that anytime you are attempting this question, you should try to make sure that you accomplish the exam within the timeline. So therefore, time management becomes very important. How can you best manage your time? Number 1, if you look at the exam, you have about 210 minutes. That's 3 hours and a half. So first of all, you have 15 minutes of reading. And I would advise you, since you have one question that is compulsory, don't spend the first 15 minutes looking at that question. It's compulsory, either you have to do it. Rather, spend the 15 minutes of reading, going through the 3 questions and try to select the 2 questions that you attempt. So that is my recommendation. Spend the 15 minutes reading and scanning quickly the 3 questions. What are the 2 questions that are you going to do? So that by the time of 15 minutes are finished, you have selected 2 questions. And of course, you selected the 2 questions based on the requirements. It is advisable always to start reading the requirements before even you read a question. Because if you start by reading a question, you finish the question, you go to read the requirement, you have even forgotten the story. So scan quickly the requirements and see, and then go back, read the scenario quickly, and 15 minutes, be done with your selection. Then you have now 210 minutes. And if you try to make an allocation, you find that on average, you have spent 2 minutes for each mark. Therefore, for the first question of 50 marks, spend no more than 1 hour and a half. For each of the second and third question or fourth question, spend no more than 50 minutes, and note down those minutes and respect them. And my advice would be, start with either the second or the third or the fourth question, whichever you have selected. Try in the first hour and a half, or about 100 minutes, try to finish the 2 questions, okay, where you need to select, and try to score the maximum out of that. Then come back with around 1 hour and a half that is remaining and tackle the first question that is compulsory. So that would be my recommendation. That is the approach I used during all of the paper I attempted, and it really revealed to be very successful. And as I said, I read the question's requirements before reading the entire question, and try to respect the proposed timelines that are here. So on average, you spend 2 minutes per each mark. And don't try to accomplish too much or say too much or maximize marks on one point, I mean on one element. What is important is that you attempt all questions. There is a requirement, you know something, try to be brief, be precise, stick to the point and move on. Keep moving on, keep moving on, keep moving on until you finish the exam. Now, here is a table. So I think Strato will share the presentation. This table is analyzing the topics that were covered during the past exams that happened from December 14 up to December 2019. So I'll not go through all of them. You take time to read it through. But what we can see from this, the summary of it is this one. These are the most recurring exam topics. One is an investment appraisal. So before I start talking about the exam topics, this course is about 2 elements, is about 2 skills you need to have. Skills number 1 is the ability to compute the present value of future cash flow. That's skills number 1. Be able to use the discounting techniques. Skill number 2 is a cost-benefit analysis. Apart from the theoretical aspect of the course, the 2 skills that you need to master in this course are those 2 that I've just highlighted. Be able to compute the present value of a future cash flow, whether it is a cost, whether it is a revenue, and secondly, be able to do a cost-benefit analysis for whatever the situation is, whether it is an acquisition, whether it is a merger, whether it is a resolve by decision, whether it is appraising the viability of an investment. It's all about cost-benefit analysis, and be able to identify what are the benefits and what are the costs, put them on the correct timeline, and be able to discount them today. So I've already explained I think the first two part, the investment appraisal and the cost of capital. These are the main topics that have been examined across all papers, across all exams, sessions. It can be lumped into one question. It can be in two questions. It can be scattered else there and there. But the cost of capital, which involved the bond valuation, equity valuation, and then also the capital structure, which comes as part of this. So another important topic. So the first two elements could be combined into one question. Another important element is the forex risk management, the foreign exchange risk management, where an investor is expecting to make a payment in the foreign currency or to receive a payment in the foreign currency or to borrow or to deposit money. How is he going to hedge the adverse movement in the foreign exchange rate? The forward contracts, the money market hedge, and the forward rates are the mostly examined topics. Then you have the business evaluation, which again comes back to investment appraisal and cost of capital. And then lastly, you have sound matters, which really are topics examined taken from there and there. It could be corporate governance, financial market, sources of finance, financial integration, dividend policy, which is an important part, performance management, and the current issues. So maybe you could be asked about the coronavirus, the impact of the pandemic on the national economy, and how that what are the strategies that the country can put in place for recovery. We have the Economic Recovery Fund that is managed by the Ministry of Finance, and investors and the donors are putting their money to support the economy. That could be a question from there. So it really, any topic can be examined from the current issues. So now let's start. What are the tips or what are the techniques that should you use to tackle any of the questions that could come from any of that topic or those topics? So let's start to go quickly looking at, very good, we have 9 attendees, that's good. Let's go quickly through those topics as I explained and see what should you know as a minimum. So take the principles of I'm explaining here as the minimum skills you should have. And then it is your responsibility to go and make sure that you deepen that knowledge, because it's a very tense knowledge, and it's not easy to explain all of them in just 3 hours. But here I'm giving you the minimum that you should know. So when you are pricing an investment, is a decision whether an investment should be pursued or not. And that decision would be based on a cost-benefit analysis. And what would be that cost-benefit analysis? Again, is a possibility to identify benefits and a possibility to identify the cost, putting them on a timeline and discount them to now, what is in common known and the net present value. So number one, you should be able to identify relevant cash flows. Relevant cash flows. When we talk of relevant cash flows, those are the future cash flows and that are incremental. I mean, these cash flows will change as a result of doing something. Let's say if a project was generating 500 Rwandan francs, and if you do action B, it will generate 700,000 Rwandan francs. The relevant cash flow is that difference, is not the entire 700,000. So you should ignore any cost that has been committed or has been incurred, or the cash items such as depreciation, a portion of overheads. Those are the things you should take out and concentrate on future costs that will be incurred in the future and are a new cost or are generated as a result of taking action A or B. The second thing you should pay attention on is whether these cash flows are nominal. I mean, they are considered in that during that time. Let me give you an example. Today we know the price of anything, but the price of that something after 5 years will be different. So the price of something today is called the current price or the real price. The price, what will be the price in 5 years, that is a normal price. And to get a normal price from the current price, you need to factor in inflation. So be able to get nominal cash flows from real cash flows. Make sure you understand how to inflate cash flows, and there is a formula that is there. I don't know whether you can see on the presentation. To inflate the cash flows, you get the current prices or the current cash flow. You multiply with that factoring factor, 1 plus inflation rate times N. N will be 1, 2, or 3, depending on the timeline. Now, when we have nominal cash flows, you should discount them at the nominal cost of capital. The other way, you can use just the real cash flows, those cash flows not inflated as they are given, and discount them at the real cost of capital. So you should make sure that you go back in the notes and read and do exercise and understand these things. When you are given an exam, be able to spot whether the figures that are given are nominal, so nothing to be done on inflating them, or whether they are real cash flows, they are given current terms and they need to be inflated. Now, the third thing you need to be able to understand is the cost of capital. We'll have a topic on the cost of capital, but know that these cash flows will be discounted at the cost of capital. It could be nominal cost of capital if you are discounting nominal cash flows, or real cost of capital if you are discounting real cash flows. So now, if you are making an investment appraisal, you could have what we call a planning horizon. This is a horizon where you can be able to forecast the cash flows with certainty. This period is normally 3 to 5 years. And then discount those cash flows, get their present value, but know that the project will not die after 5 years. The project will continue. And therefore, you should be able to determine what we call the terminal value. And the terminal value is the present value of the cash flows that will arise after the 5th year. So you can be able to compute this. I gave you some formulas. There are 3 important discounting formulas, and you should be able to differentiate them. One, if you have different cash flows for a given time period, the cash flow in year 1 is different from the cash flow in year 2, is different from the cash flow in year 3, etc. You should be able to use a simple discounting factor, which is given there. The cash flow times 1 out of 1 plus I, whatever, the formula is there. So that's the discounting factor for unequal cash flows. Now, if you have a stream of equal cash flows, I mean, if the cash flows are constant, year 1, year 2, year 3, year 4, year whatever is, the cash flows are the same, 1 million each year. Don't spend too much time discounting each cash flow. Just take that single figure and apply the annuity factor that you are seeing on the screen. Another possibility could be discounting perpetuity cash flows. These are the cash flows that will come for indefinite. Case could be investment in life schemes, health, I mean, life insurance, perpetuity bonds. So if the cash flows will flow for indeterminate time, the discounting factor is simply 1 divided by the cost of capital divided by interest rate. So you should be able to differentiate whether you are using simple discounting factor, whether you are using annuity factor, and whether you are using the perpetuity cash flows. Then, how do you determine the terminal value? I mean, the value of cash flows after the planning horizon. You should use the Gordon growth model. Strato, is there a way to record this video? Hello?
Yes.
Is there a way to record
we are
this
recording.
video? Okay,
Yes,
very
it's
good.
recording.
So you should be able to use the Gordon growth model. I have given you the formula. X stands for the cash flow. Don't worry, they are recording it, so they keep it in ICPAD. So X is the cash flow at the end of the planning horizon, let's say year 5. Then G is the constant growth rate of cash flows. There are different ways of getting the constant growth rate. Either it will be given or they give you some hint to get the constant growth rate. And then we divide by the cost of capital minus that growth rate. So now, there are special considerations that you should have when you are computing the free cash flow, because you'll be discounting the free cash flow. Of course, you'll be getting revenues, you'll be getting cost, but there are 3 main considerations. Number 1 is capital allowances. Capital allowances, these are the allowances that the tax authority gives to the investor to be able to put aside some money to replace the asset. So be able to compute the written down allowances, which is normally a percentage or applied on the cost of the asset on a reducing balance, and be able to compute the tax savings arriving from those written down allowances. I've given you a sample here down. You can see, you can look at later. So be able to have a table like this. This is the initial cost of the asset. Then written down allowance in year 1, it will be a percentage, probably 25% on reducing balance. Then be able to compute the saved tax like this. And for the last year, know that the written down allowance will be a balancing figure between the net book value at year 3 and the residual value at year 4. Don't apply the whatever percent, is just a book value, a balancing figure. Sorry, it's a balancing figure. Then this saved tax will be added to your cash flow computations as benefits. So this one consideration you should be able to do. Tax savings on capital allowances. Then the second consideration is a working capital requirements. The business, when you invest, you put in some money to buy assets, to buy equipment, to kick off the business. But as the business to run, it will need the working capital. Normally, the working capital is the difference between the current asset and the current liabilities. But it means this the money to be able to purchase inventories, to pay salaries, be able to pay other creditors, suppliers, while you are waiting to collect the revenues from receivables. So they will be given a magic formula to compute the working capital requirements. It could be a percentage on revenue, it could be something. So be able to determine what is the level of working capital that will be required for each year, and you know that the cash flow is not that level of working capital, is the change in the working capital. It's only the change in the working capital that is a relevant cash flow. If the working capital in year 1 is at the beginning is 500, yes, that's a relevant cash flow as an outflow, negative. If the second year is 700, the relevant working capital, the relevant cash flow for working capital is that change from 500 to 700. And if there is an increase in working capital, that will be in the cash flow it will be marked as a negative, as an outlay. If the working capital is decreasing, that will be marked as a positive, as a benefit. And also appreciate the fact that at the end of the planning horizon, the total sum of the change in working capital should be zero, because in the principle, whatever working capital that is invested at the beginning will be recovered at the end. So be able to compute the change in the working capital, and if you sum them across, you should get zero. That is one way to really make sure whether you got it correct. Now, another thing you should pay attention to it is the treatment of interest expenses. When you are evaluating an investment, please know that an investment could be financed either by an equity or a debt or a combination of the two. However, there is a consequence. If an investment is financed by a debt, there will be interest to be paid. If an investment is financed by equity, there will be dividend to be paid. And paying interest could lower the profitability, but the viability of an investment should be assessed irrespective of how the investment is financed. I will repeat this because it is really very important. The viability of an investment should be assessed irrespective of how it has been financed. What does it mean? When you are computing the free cash flow to the firm, don't put interest expenses, because both interest and dividends are remuneration to funders, either lenders or equity holders. So that's why it is very advisable when you are computing the free cash flow to start with from the earning before interest and tax, so that you get rid of interest. Interest will come later in the distribution. The free cash flows will be distributed either as retained earnings, either as interest to lenders, either as dividend to shareholders. It is very important that interest is not deducted in your cash flows, or whether you start from where interest is deducted, be able to adjust it back. But my recommendation is to start with earning before interest and the tax. So then another important aspect is that the timing of cash flows is very important. Timing of cash flow. Be able to draw a line. If you can be able to draw a line and put 0, 1, 2, 3, as you can see here. I have year 1, year 2, I forgot to put year 0. Year 0, normally you put the cost of investment. Year 1, year 2, year 3. Make sure you put the relevant cash flow on the correct line of the time. When is the cash flow coming? Some revenues will be earned this year, but they will be received next year. A portion of revenue will be received this year, a portion of another revenue, most likely the revenue in December or the last 2 months, will be received next year. A portion of expenses as incurred in this year will be paid this year, and another portion will be paid next year. And very specifically taxes. It's most likely that taxes will be paid next year. So pay attention to the timing of cash flow, because the discounting is properly applied when the cash flows are put on the correct timeline. So briefly, these are the main tips you should do when you are making an investment appraisal, and then assemble those pieces into a comprehensive table where you have, you can follow it later, but this table will help you really to determine the free cash flow, discount them at the appropriate cost of capital, get the present value, deduct the cost of investment that I forgot to put on year 0, and you have your net present value. And I believe you all know how to make an interpretation. If the NPV is positive, the project is acceptable. If negative, the project should be refused. If it is 0, it is up to you to decide whether you want to pursue the project. You may pursue it because of other considerations, salaries it will pay, the contribution it will make to the economy. And remember to add the terminal value if you've discounted your cash flows for the first 5 years, or 4 years, then add the terminal value. I've given you the formula above, which is this one, the formula for the terminal value. Add it to the present value of these cash flows, and you really get the value of your investment. Another factor or another aspect you need to consider is the internal rate of return. Be able to understand what is the internal rate of return, how is it interpreted, and what is the use of it. An internal rate of return measures the ability of the investment to generate revenues given the cost put in. In simple terms, these are the level of returns that are going to investors. And it's very important in a simple aspect. You should get more than what you are giving. That's the CBA, the cost benefit analysis. So for you to be able to understand the internal rate of return, if the cost of capital, let's say, is 15%, okay? If the internal rate of return is also 15%, it means the project is in break even. It's neither profitable, it's neither viable nor not viable. It returns as much as it costs. It's a zero-sum game. What you invest is what you get. If the internal rate of return is higher than the cost of capital, that is very good. Your returns are higher than the cost of your investment. And the other way around also applies. So this is one way of making a decision based on internal rate of return. Compare the internal rate of return with the cost of capital. Of course, if the internal rate of return is greater than the cost of capital, of course, the project will have positive NPV. If the internal rate of return is less than the cost of capital, the project will have a negative NPV. So the IRR and NPV, they are two sides of a coin. So that's one way of appraising it. Is IRR higher than the cost of capital? The other way you can appraise the viability of an investment using IRR, sometimes a company may have a policy of investing in projects with IRR higher than a given number, higher than 20%. So compute the IRR. If IRR is less than that target, know that the project is not good. So these are the two ways you can use the IRR. You have the formula here, how to compute the IRR. I will leave it for you to interpret. But basically, IRR is computed via iteration method, where you take a higher rate and a lower rate. You compute the NPV for a higher rate and a lower rate, and then you apply this formula. So briefly, those are the important things you need to understand. So I'm going through yes, we are following Etienne Bizimana, that's good. Yes, the PowerPoint presentation will be shared. Good. Now, second, we talked about the cost of capital. You need to discount the cash flows using a discounting factor. How do you get a discounting factor? One, a discounting factor may be given to you, or you may be required to. Yes, I see in this, Eric raised the hand. Yes, Eric, a question? Eric, do you have a question? Yes, go ahead, please go ahead. You can talk to me directly or put a question in the chat. Eric? There you are. So you need to unmute. If you can see where you have a mute, should be able to see like here. This, so I'm using two computers. If this one unmute is close like this, if you talk, we'll not be able to listen to you. If you need to talk, you need to do like this. Okay? You need to unmute. So. Okay. So Eric, please put your question in the chat. I'll come back to it. So let me repeat how we should be able to talk. So you should look at this sign here. If it is closed, it means you are on unmute. And then if you need to talk, you need to unmute yourself. So you can see when I unmute, I think you are hearing two voices. The one on the computer I'm using and the other on the iPad that is capturing my voice. Once you finish talking, unmute you again. Okay, so let's continue. And if you are not able to talk, please put your question in the chat. Now, so I was talking about the cost of capital. One, you can be given the cost of capital, very easy. The discounting factor is this one and use that one. Then where do we find an mute option? If you drag your mouse, you should see, I don't know whether you are using a computer or a phone, try to look at the upper corner where you are using to put the chat. Like you are able to put the chat here, but look at this one, unmute. Okay. Okay, let's continue. So you should be able to compute the cost of capital. The cost of capital, of course, is a combination of. So first of all, capital is debt and equity, and debt can have different types: redeemable debt, irredeemable debt, convertible debt. Could be a preference share, ordinary equity. All of these are called the source of finance or capital. Now, this is an interesting topic because it will give you the rate you'll be using in discounting the cash flows. So you should be able to compute the cost of debt, which will also allow you to do the bond evaluation. Bond evaluation can be also an interesting topic to be examined. You should be able to compute the cost of equity and then the weighted average cost of capital. So let's start with the cost of debt. To be able to compute the cost of debt, you need to identify what type of debt do I have. That's the first thing you need to do. It could be irredeemable bond. That's a bond that will never be repaid back. You buy a bond, you are given a stream of cash flows that are called coupon payments for indefinite time. If that is the case, the cost of debt, which I labeled KD, will be equal to the coupon interest that you receive, they are called the coupon, and the coupon are computed based on the coupon rate. If the coupon rate is 5%, and the face value over that is 100, the coupon will be getting is 5, meaning every year you'll be getting 5 Rwandan francs for 100 Rwandan franc note. And bear in mind that a coupon could be paid in semi-annual or annual or quarterly. But in most cases, coupons are paid semi-annually. So bear in mind semi-annually and be able to adjust your computation. So the cost of debt for a redeemable bond will be the interest, or which we compare as the coupon. You divide by 1 minus T. Sorry, interest times 1 minus T out of the PO. PO stands for the purchase price. Why are we multiplying by 1 minus T? This is to capture the tax deductibility of interest. If you receive a coupon, it is taxed. So the net you get, basically this is the net. Interest times, let's say, if the tax is 70%, if you get a coupon of 5, the net will be 3.5. So basically the entire of this fraction, I mean the entire of this will be 3.5. Then divided by the bond price, the price of the bond. The price of the bond is the amount you pay now to be able to purchase that price. Then a redeemable bond, this is a bond where you receive coupon payments, but then at the end of a certain period of time, let's say 5 years, 3 years, you'll be able to get back the face value of the bond. Face value could be 100 Rwandan francs or 100,000 Rwandan francs. So let's take a typical example, and you can apply this knowledge in binary treasury bonds. Binary issues treasury bonds that pay coupons on a semi-annual. Let's take an example of a coupon of 10%. So what will be the price of that bond? A bond will have, let's say, a nominal value of 100,000. Let's just use a figure 100 Rwandan francs. It pays a coupon rate of 10% semi-annually, okay, for 5 years. And after 5 years, it will be redeemed at par. At par means at the face value of 100. How would you value this bond? Okay, use this format. Remember, valuing a bond is to get the present value of future cash flow. So the price of a bond, the price you pay today, okay, should be equal to the present value of coupons you're receiving in the future, plus the fair value you get at the redemption of that bond. You should put this principle into your perspective. I repeat, the price of a bond today, so how much you pay today to be able to buy that bond, should be equal to the present value of the coupons you are going to receive and the amount you receive at year 5 when the bond is redeemed. So let's apply this knowledge. Simply draw this table, put the period, year 0, you pay the bond price. That's an investment, that's why it is negative. Let's say you pay 95 for each 100 note. So the bonds will be put into pieces of notes, like a note of 100. So let's say the bond price is 95. So there are 3 parameters here involved. There is a bond price, there is a coupon, and there is a cost of that debt. Normally, the cost of the debt for a redeemable bond is also called a yield to maturity. You'll see the word, the YTM. A yield to maturity is simply the cost of the debt, the annual cost of the debt, and is simply the discount factor. So yield to maturity, the cost of the debt, the discount factor for redeemable bond, these terms means the same thing for simplistic purposes. So now we are going to value this bond. If we know the bond price, we should be able to get the discounting factor or the yield to maturity. If we know the yield to maturity or the discounting factor, we should be able to get the bond price. So this table will help you either to get the bond price if you have the yield to maturity, or to compute the yield to maturity if you have the bond price. So before I finish, I want to state that for redeemable bond, the cost of capital is also the internal rate of return. So if you are computing the redeemable bond, cost of capital, internal rate of return, yield to maturity, it's a discounting factor. All these terms for simplicity purposes, they mean the same thing. So now, come back, draw this table, put the period here. Year 0, you pay the bond price. Let's say 95. Put minus 95 here because it's a cost. At how much do you discount this minus 95? I think I put this is 1, okay? The discounting factor at year 0 is 1. So you have your discounted cash flow here, which is minus 95. Now, from year 1 to year 5, you'll be receiving coupon payments. So this will be given based on the coupon rate. So here you have the formula. The coupon payment is equal to the coupon rate plus the bond face value. The face value is 100. Don't confuse the face value and the bond price. The face value is just a figure, I mean the nominal value of the bond. So if the coupon rate is 5% or 10%, so means each year you'll be getting 10, okay? So 10% times 100, which is the face value of the bond. Each year you'll be receiving 10, so you put 10 here. You'll be receiving 10 Rwandan francs, year 1, year 2, year 3, year 4, year 5. This is a series of equal cash flow. They should be discounted at an annuity factor. Discount that 10, you get the present value of these coupon payments. Remember, if the coupon payments are semi-annual, remember to make an adjustment. So rather than getting 10, you get 5. But it's also very good to, you can factor in the tax rate so that you use the coupon payments after tax. If you don't use the coupon payments after tax, you may be in trouble. So be able to use the coupon payments after tax. So you put, it will be 5, if that's after tax, or 3.5, and be able to make an adjustment. You have to divide by 2, then times 2. So, I mean, how do you make the discounting when the period is semi-annual or a quarter? You should be able to compute that. Now, at the 5th year, you get the bond will be redeemed at 100 fair value, can be redeemed at par or at a discount or at premium. Put whatever redemption value is here. So if it's a face value, put 100 here. It's one number at year 5. Put the simple discounting factor, discount it, and if you add this, you should be able to get the bond price. So if you did not know this one, the bond price, but you knew the cost of debt, you can have this one, and you'll get the value here, the bond price, which is the present value. If you knew the bond price, okay, you can do a iteration, use this one to be able to compute the internal rate of return, which is the cost of the redeemable bond. So quickly, this is how we value the redeemable bond. A convertible bond, the valuation is the same as a redeemable bond. The difference will be that at year end, you need to determine whether it is beneficial to redeem the bond or whether to convert the bond. If the bond will be converted, replace the redemption value with the conversion value. Now, so once you've determined your cost of debt, either irredeemable or convertible, it's now the time to compute the cost of equity. Okay, sorry, I skipped the cost of equity. Now, how do you compute the cost of equity? There are two ways of computing the cost of equity depending on the information that is available. One, you can compute the cost of equity using the dividend growth model, DVM. You have the formula here. So basically, the cost of equity is the dividend that has been paid, DO. Is the dividend at year zero. They just paid the dividend, grow it at the growth rate you have, 1 plus G, divided by the value of the share, PO, or the share price, plus the growth rate. Okay? How do you get the growth rate? You can use the compound annual growth rate, or the growth rate could be given in the question. Are you still following? Please put in the chat to let me know if you still hear me, if we are still together. I would like to get your feedback. Eric, thank you. Okay. And yes, if I'm going too fast, do I need to go too fast because of limited time? Please let me know. Okay, good. So the first way of getting the cost of equity is to use the dividend growth model. And if you have things like the dividend paid, the dividend for the last 3 years, it can be used to compute the growth rate in dividend. That is an indication that the growth model, the dividend growth model, is the most appropriate. The second way you can compute the cost of equity is to use CAPM, the capital asset pricing model. So if you have things like the risk-free rate, the beta, the return on the market, know that you need to use the CAPM, where the cost of the equity is that just the expected return on equity. Be able to revise the meaning of beta, alpha, beta. I have put the explanations here. Basically, beta, beta is the measurement of the risk of the asset, or the risk of investment, the risk of shares relative to the market. If beta is greater than 1, the investment, the shares are riskier than the average market. If beta is less than 1, the risk, the asset or the investment or shares or the project where you have invested is less riskier than the average risk of the market. Now, what is alpha factor? When you compute this, you get a number. Let's say you get 20%. That is an expected return. Actually, on the market, the return could be 25%. You do a computation, expected return is 20%. But on the market, return is 25%. The difference is called alpha factor. That is abnormal return. When you invest in that business, you expected to get 20, but the actual return is 25%. There is abnormal return, probably because there are greater risk or other market consideration. That's the meaning of alpha factor. If alpha factor is positive, the investment is yielding more than what it was expected. If for alpha is negative, the investment is yielding less than what it was expected. Now, so you have your cost of equity, you have your cost of debt, then come and lump them together in computing the cost of capital. And if the investment is solely financed by equity, discount it using the cost of equity. If the investment is solely financed by debt, I don't see how it could be possible. Discount it using the cost of debt. If the investment is financed by both equity and debt, discount it using the weighted average cost of capital. I don't know how you call it in abbreviation. So this is the formula where you take the cost of equity, you put the weight of equity into, so this is the weight of equity, plus the cost of debt after tax cost of debt. Remember, we did not put interest expense in our cash flows. If you go back earlier where we started, I mentioned start from earning before interest and the tax. We ignored interest. However, we know that if the investment is financed by debt, there will be tax savings from paying interest, because interest is tax deductible, and it will be factored here. So if you put interest earlier, you will be double counting. I mean, yes, you'll be double counting it. Use the after-tax cost of debt. Whatever cost of debt you found, if you found that the cost of debt is 20%, use 70% of it, which is 14%, okay? And then multiply by the weight of debt in the equity and debt. Then you get your weighted average cost of capital. Importantly, when you are using the equity or debt, please use the market values. You'll be given book values in the extract of the financial statements. If you have an information to get market values, ignore the book values. See a way of getting the market values. It could be taking the number of shares times the share price. If the share price is given, know that there is a way of getting the market value of equity. Ignore the equity that is in the financial statement. If there is a loan that is the financial statement and you have numbers that could allow you to compute the bond price, first compute the bond price and get the value of the bond. Use that market value rather than the loan figure that is in the financial statements. So that's all for the cost of capital. If there is any question, please put in the chat. Let's keep moving. Now, the capital structure, we were talking about equity and debt, how they'll be combined to finance the investment. This is very important. The capital structure means the level of equity and debt in the total financing. It could be 50%, 50%, 70% debt, 30% equity, or whatever proportion could be. Simply, that's what the capital structure means. Now, why is it important? One, the capital structure is very important because it is used to compute the cost of capital. I could simply put 30% here and 70% here. You may be given those proportions. Okay? So that's the first reason why the capital structure is very important. But more importantly, the capital structure has an impact on the risk of an investment, beta. Okay? So, if you want to make an investment, you need the cost of capital, the cost of debt, cost of equity, whatever it is. Sometimes you could be given another company, the information of another company. Let's say someone wants to invest in transport. He's in a industry, he's in a hotel industry, and he wants to diversify and invest in transport. But where he is now, he has a capital structure of 70% equity, 70% debt and 30% equity. So then you are given information of the transport sector where he would like to go, and you are given the beta of that transport sector, which is a measure of risk there. But the company you are given as a sample in transport sector, the capital structure is not the same as the capital structure where you are in the hotel industry. Let's say the capital structure is 50%, 50%. Where the bottleneck is, how do you get beta of the new investment you are going to make in the transport sector? You cannot use the beta of that company in the transport sector because the capital structure is not the same. Here comes the skills of ungearing and regearing. This is itself is a whole topic. I'm just shedding light on it so that you go there and read. So when do you engage in angearing and regearing? Let me repeat the scenario we have here. We have information of the hotel industry. We have information of the transport sector where we want to go. So what you need to do, you will get a beta of the company, the transport industry, that is financed the 50-50, and gear it, which is asset beta, get the beta of that company if it was purely financed by equity. If the current beta you have is 1.5, when it is financed at 50%, when you ungear it to be financed solely by equity, the asset beta could be 2, because asset beta is always somehow greater than the company that is financed by the combination of the two. So the asset beta, the equity beta, then so get the beta when the company was solely financed by equity, okay? And then regear it to the capital structure, you will be having maybe 70-30%. You'll get the appropriate beta to use for the new investment, and then come back, apply that beta to the capital asset pricing model. So anytime you want to do a diversification from this sector to another sector, bear in mind that you may need to do angearing and regearing. I will stop there and encourage you to go and read the whole story on angearing and regearing. And of course, there are also theories about importance of capital structure. Does it add value to finance the business with more debt, with less debt, with less equity? Go there and read the principles of Modigliani mirror theory. What happens if there is a tax? What happens if there is no tax? So those are the theories you should be able to read and understand. Now, those principles you are running, you are expected to apply them in mergers and acquisitions and business evaluation. So typically business evaluation is almost the same as investment appraisal, where you have an existing company. The difference is that investment appraisal is mostly for a new project you are going to do, where you have to estimate the future cost, the future revenues, but the business evaluation is to come up with a value of an existing business for different purposes, either for selling purpose or for whatever purpose it is. So the principle here is be able to determine, be able to make a cost-benefit analysis. What are the benefits? What are the costs? Let's take an example of an acquisition. How do you tackle a question on acquisition? First of all, you need to compute the net benefit of acquisition. How do you do it? First, be able to compute the cost of acquisition. What is the cost of acquisition? Is how much you pay to acquire a company. It could be the value of the shares you are giving. It could be cash. It could be other injection you are making in the business. Be able to compute those costs. Then what are the benefits or synergies that will come out of that acquisition or merger? It could be additional retained earnings that will be generated. It could be save the cost from merging support departments, the finance of two companies are merged into one, the procurement, the HR. It could be the increase in sales. And while the cost mostly will happen at year 0 when you make an acquisition, know that these benefits will accrue over time. Therefore, be able to discount them to their present value. You could be given a scenario where the net earnings will increase by 20% for indefinite time. So get that 20% of the change in revenue and discount them to the present value using the perpetuity discounting factor. So be able to measure the benefits and discount them to the present value, then compare the cost and the present value of the benefits. If you have net benefits, the acquisition should go ahead. If you have negative net benefits, the acquisition shouldn't go ahead. So then of course, how do you value the purchase consideration? As I said, could be the value of shares, be able to make the valuation of shares. Either you can use the earning per share, the price earning ratio, the dividend valuation model, the CAPM, all these principles we've seen now. And you should be able also to make a valuation of like company A and the company B, they want to merge, should be able to value company A separately plus company B separately. You get the total, then make a valuation of the combined company and see whether the value of the merged firm is greater than the individual values added of the two companies considered separately. So if the value of the combined firm is greater than the sum of the individual companies considered together, then the merger or the acquisition or whatever should be recommended to go ahead. So basically, that's how you should be able to tackle the merger and acquisition question. Be able to identify cost, be able to identify the benefits, discount the present value of the benefits, and compare the benefits and the cost. Now, while in a investment decision, there could be special consideration. There are special cases that could arise. One is a capital rationing. Capital rationing is a case where you want to make an investment. You have many projects that you are considering, 5 projects. But if you look at the cost of all the projects, the total cost of the projects, the 5 projects is 2 million, but the amount of money you have is only 1,500,000 Ugandan francs. So you are not able to invest in all projects. You need to make a selection. That's the case of capital rationing. And you should make a selection based on, so there are 2 ways. One, if the projects are divisible, I mean, you can invest in an entire project or a fraction of the project. You should use what we call a profitability index. The profitability index, simply you take the present value of future cash flows, you divide by the investment. That's the profitability index. If you get 1, it means the present value of future cash flow is equal to the investment. In other words, your NPV is 0. And if the profitability index is greater than 1, the future cash flow will be more than the investment. The project is good, so the profitability index will be greater than 1. So compute the profitability index for each project, and then rank the project based on the profitability index. Then start allocating available funds from rank 1, rank 2, rank 3, until your funds are exhausted. So that's when the projects are divisible. But if the projects there could be cases where they are mutually exclusive or non-divisible or mutually dependent project. Like if you invest in the project A, you should also invest in the project C. If you invest in the project B, you cannot invest in the project A. If you have a scenario like that, ranking of profitability index is no longer working. What you do, compute the NPV of each project, then start making a combination that can be financed using your available fund. Let's say, if I combine A and B and D, how much NPV do I have? If I combine C and D and X, how much NPV do I have? Use the iteration method to get a combination that, of course, within the limit of available fund, a combination that gives the maximum NPV. So that's case number 1. Another complicated case in investment decision could be risk or buy decision. So I propose that I want to take a break of about 10 minutes. During the break, you can put a question in the chat. I'll be back in not more than 10 minutes. So you can put the question in the chat. I think you are all able to see the chat. Then I'll respond to those questions. I'll leave the presentation on. Thank you. Hello. Okay. So let's continue. I was going through your questions. Sandrine is asking, can you please give us a practical example on how to gear and regearing better when you want to diversify your investment? Then Elvis, would you can tell us about a working capital management and dividend policy? I'll come to that. We'll have an overview of the course. What do you mean? Etienne, could you clarify what do you mean by an overview of the course? There is, I don't know whether we started together. I talked about the most examined topics and the topics that need to be covered and what I'm presenting. And Eric, I'm wondering if we will have corrected the past paper. I don't think we can do it in 3 hours. Help on tackling questions. I thought is what I'm doing. Tell me how I can do it better. Advise how to approach corporate strategic management paper. What is this corporate strategic management? Do you mean strategic? So there is a presentation I made at the beginning. I don't know whether you were here or let me know what else I can add on. What do you mean by iteration method and how is it used? Okay, so let me respond to these 2 practical questions, iteration, and let me start with the iteration method. So if you look at the, you mean iteration in capital rationing or in internal rate of return? Jean-Pierre, can you please clarify? Just type in, do you want iteration for capital rationing or for internal rate of return? So once I know what you mean, I'll come back to that question. Gearing and gearing. So, okay, let me explain using this question. Asset beta and equity beta. So the beta of the company that is geared, I mean, a company that is financed by both equity and debt, you'll be given that we are seeing here. First, to convert that equity of a company that is financed by equity and beta to a company that is financed only by equity. I see that my internet connection is not stable. Can you hear me? Can you hear me?
Yes.
Okay. So then what you do, you apply this formula, the geared beta that you have, you use this formula, and to get the ungeared beta, Now, so when you have the yield beta and you replace in this formula, you have the value of equity. Use the capital structure that you have 70%. So you have the value of equity and the value of debt for that investment where you want the sector where you want to invest. You replace in this formula, you get the asset for a company that is ungeared. I mean, the company that is financed only by equity. Then you come back to your capital structure you'll be using for that business. So you got the appropriate beta for the company that is not geared by mid for the company that is financed only by equity. But you would like to use a given capital structure, maybe 40%, 60%. You come again, you find the beta of a geared company using that capital structure. So maybe I will try to get some concrete numbers at the end of the presentation, and then I can note down those numbers and try to use them to show you how you can compute that. So let's try to continue. We were in the lease or buy decision. Let me see if I can accelerate so that we finish and we come back to questions. So when you have questions of lease or buy, there are two important decisions you need to make and in the process. One is before you think of leasing or buying, should you even invest? Like there is a decision to bring an equipment to improve on the processes. And then they ask you whether you should buy that equipment or whether you should lease that equipment. The first decision you need to consider is, should we even acquire that asset? By looking whether the cost of acquiring the asset and the cash flow, the net cash flow the asset will bring, whether it will have a positive NPV. So how do you do that? Start with an investment decision. Should we acquire this asset or not? You should, what are the relevant cash flow for the acquisition decision? This table that you see here, the relevant cash flow one is the machine cost. So take the cost of the machine, put at year 0, and then once you purchase that machine, you'll get the tax relief for the machine, the written down allowances. Put the written down allowances, it will be a percentage on reducing the value of a machine. Then put your operating cash flow. These are the incremental cash flows that will be brought by the existence of the asset. If you bring the asset in the business, how much will be a change in your cash flows? Put the operating cash flows here, and then they should be taxed, tax them, and you get your net cash flows. Net cash flow is a sum of the machine cost and tax relief on the machine cost using the other table I showed you. This one, the tax saved on the machine cost. And then you add together, you have your net cash flows, discount them to the appropriate cost of capital. This basically will be the cost of the company. And then if you get the NPV that is positive, the decision is that this asset can be acquired. So that will be step number 1. If the NPV is negative, stop there. Don't even think of lease or buying. Now, assuming the NPV is positive, go to the second step, financing decision, okay? How can you finance this asset? Should you buy or should you lease it? Now, you need to compute the NPV of the leasing option and NPV of the buying option and compare. So what would be the relevant cash flow for the leasing option? One will be the lease payments. These are the annual leases you are paying. They are negative because these are the cash outflow. But remember, lease payments, these are expenses that are tax deductible. If you have a revenue of 100, you have a lease of 30, what is taxed is the net, which is 70. Okay, so you should compute the tax relief on lease payments. This is basically the tax rate times the lease rentals. These are the benefits. And then you get your net cash flows, discount them, applying a discounting factor, and get the present value of the leasing cost. What should be the discounting factor? The discounting factor is different from the discounting factor used in the acquisition decision. And this should be the borrowing cost, because either you lease or you buy. When you buy, you could finance the acquisition by a loan. And always this cost of capital should be after tax cost of capital. Now you have the present value of leasing cost, and of course it will be negative. Then put that figure there and go and look at the purchasing option. What if I purchase this? When we purchase this, relevant cash flow number one will be the cost of purchase. That's the machine cost that we put here. Then you get the tax relief on the machine, the other written down allowances as benefits, and these are the only cash flow. Remember, there are no lease rentals here. So look at the comparison of the two. Here you have the machine cost and the tax relief on machine. While for leasing option, you have lease payments and the tax relief on payments. So be able to separate the relevant cash flow under a leasing option and purchasing option. You discount this net cash flow, you get the present value, which is the cost of the acquisition. I mean the cost of the purchase option. Compare the two. So you should select an option with a lower cost. If the present value of the purchase option is lower, because remember we are discounting the cost. So where the cost is lower is the option that we should tackle. So briefly, that's how we should tackle the lease or buy option in 3 steps. Step number 1, should we even make this investment? That's an investment decision, know the relevant cash flow. Then if the decision is to go ahead and make an acquisition, should you lease it or should you buy it? Differentiate the cash flows when leasing and differentiate the cash flow when buying. And remember to use the appropriate cost of capital. The cost of capital for investment decision will be the company's cost of capital, of course, after tax. But the cost of capital for leasing or buying, the appropriate cost of capital will be the loan rate. So you'll get it, mostly you get it two rates, and don't be confused. Be able to apply the lending rate on the leasing or buying option and the cost of capital, the weighted average cost of capital on the acquisition or investment decision. There could be another topic on replacement decision. Time is not on my side, so I'll not dwell too much on it. But I want to emphasize one key element, what is called equivalent annual cost or equivalent annual cash flow. This principle can be applied here or it can be applied in investment decision. Anytime you are appraising different projects with different timelines, let's say you have project A that has 3 years. You have a project B that have 6 years. You have a project C that has 8 years. Much as you do the present value to get the discounted cash flows, but it's better to compute what is called as the equivalent annual cash flow. What is the equivalent annual cash flow? Simply get the present value. Let's say you get the present value of the project for 3 years, the NPV for the project of 5 years, NPV for the project of 7 years, then divide with the discounting factor, the annuity factor on each period. So take the NPV of the project of 3 years, divided by the annuity factor of 3 years. I hope you remember how to compute the annuity factor. Get that number. For project of 5 years, get NPV for 5 years divided by the annuity factor of year 5. Okay, annuity factor, I mean this formula. This one, annuity factor of year 5. If you put 5 here, you get the annuity factor for year 5 or for the entire 5 years. Then for the project of 7 years, you computed its NPV, but divided by the annuity factor of year 7. So then you have the 3 figures, compare and select the project with the higher equivalent annual cash flow. That's the principle of equivalent annual cash flow, is mostly used when you are evaluating a project with different lifespans. It can also be used to select the timing of making a replacement of the asset. Should you be replacing asset each year? Should you be replacing the asset every 3 years or every 5 years? So use the same logic. Compute the present value if you replace each year, the present value of cash flows. I mean, it's the benefit, how much the asset will be generating, and the cost of replacing that asset in year 1. If you would like to replace for every 5 years, compute the cash flow in year 1, year 2, year 3, then put the replacement cost in year 3 and compute the present value. Same applies for year 7. Then divide by the discounting factor of each year to get the equivalent annual cash flow. And then select the project with the lowest cost, because these will be the equivalent annual cost. So there was a question, the risk management, I think. Okay, capital rationing. Jean-Pierre, I'll come to your question. It's clear. Now, so risk management and portfolio, they could be a question, they may not be a question, but basically the NPV you've got of the project, you need to do a sensitivity analysis. The sensitivity analysis can be to ask tell us about replacement of a full depreciated asset. So when you are replacing a full depreciated asset, one, in cash flow, depreciation doesn't matter. What matters is the resale value, okay? So when you replace the asset at year 3, will you be able to sell that asset and get a resale value? Or a scrap value? The scrap value will be a positive cash flow at year 3, okay? So how much the asset will be able to generate? You have cash in year 1, year 2, year 3. Then when you replace it, how much will you pay to buy a new asset? Put that at year 3 as a cost. And can you sell this asset and get a scrap value? If that's the case, put the scrap value at year 3 as a benefit and discount those cash flows. So let me know if that's clear. So for the risk management, I think I have about 1 hour and 10 minutes. So about the sensitivity is, one, if you are being asked to compute the sensitivity of the cost of capital, it's basically the internal rate of return. That means if the cost of capital was to increase by 2%, what will happen? Okay, so the internal rate of return will make your cash flow NPV being 0. Okay, if you increase, so if you have your internal rate of return 15%, please know that if the cost of capital becomes higher than 15%, your project is no longer viable because the NPV will become negative. If the cost of capital go lower than IRR, know that your project becomes, the NPV becomes a positive. So the simple formula of computing the sensitivity is that you get the NPV of the project you computed. And if you want the sensitivity about the change in revenue, get the line of revenue, compute the present value of those revenues. Okay, get that figure and divide the two. Get the NPV divided by the present value of the revenues. You'll get a sensitivity when the price changes. So if you get like a figure, let's say 5%, it means if your revenue change by 5%, the project may become not bankable or not viable. If you compute the sensitivity around the cost, get the operating cost, take the present value of the operating cost, and then take the NPV of the project divided by the present value of those costs you discounted. If you get a figure, let's say 10%, it means if the cost you used go up by more than 10%, your project is no longer viable. Another way is to compute the expected values. You could have different scenarios. Like scenario A, expected return could be 5%. There's a probability attached to that. Scenario B, expected return could be 10%. There is a probability attached to that, and so on. Be able to compute the expected values, which is a weighted average. So you get a probability times the expected NPV plus probability of the second scenario plus expected NPV, like that, and that will be your expected value. This is a scenario where you could be given an investment and they give a likelihood, okay? If option A, this is the return, option B, this is the return, option C, this is the return. So you should make a decision based on the expected return. The portfolio theory, this is a case where you have more than, like you have 2 investments and you want to do a diversification. So what is the return on the portfolio? Should be able to compute the return on a portfolio. So you should first be able to compute the weighted average. What is the proportion of investment A in the portfolio? Let's take an example. You invest $1 million in asset A and you invest $2 million in asset B. Asset A and B make a portfolio. How will you compute the expected return on that portfolio? You will take the return on asset A times the proportion of asset A in the portfolio plus the return on asset B times the proportion of that asset in the portfolio, and the proportion being the investment in A times the total investment, like that. So that's how you compute the portfolio return. Now, to measure the risk of the portfolio is used to diversify and to reduce the risk. You should be able to compute the standard deviation. The standard deviation is the measure of the risk. The higher the standard deviation, the higher the risk. The lower the standard deviation, the lower the risk. There is a formula here you should apply. And if you compute the standard deviation of an investment, project A, and then you compute the standard deviation of the portfolio, and you find that the standard deviation of the portfolio is higher than the individual standard deviations, know that your diversification has not worked. Because when you diversify, the standard deviation of a portfolio should be lower than the individual standard deviations. That's how you assess the risk of a portfolio. And for it to be successful is that the correlation between the 2 assets should be negative. If you invest in assets that are positively correlated, if a shock happens in asset A, it will also affect asset B. In that case, when you compute the portfolio risk, it will be higher than the individual risk of the asset A and B. So the correlation or the covariance should be negative. Now, another interesting topic that is mostly examined is the foreign exchange risk management. There is a lot that could be asked, but bear in mind 4 important topics here. One, how can you hedge the rise in exchange rate if you expect a future payment, or the foreign exchange rate if you expect future receipts? There are mechanisms here that can be used to hedge, invoicing the domestic currency, reading and lagging, etc. But the most examined questions that involve computations are forward exchange contract, money market hedge, and future rate agreements. Okay, so let's spend some few times on this. I don't know whether you can see this. What are the forward contracts? So the forward contracts are the contracts entered today to buy a currency, dollars, pounds, or whatever, so to buy a currency in the future, but are at a rate determined and agreed today. Let's say I think I'll be buying dollars 3 months to come, and I'm worried that the exchange rate could move from $1 equal to 950 to $1 equal to 1,200 Rwandan francs. I can have an agreement with a bank that the rate I'll be buying at 1,000. That will be called a future rate. Okay? Now, so how do you hedge foreign exchange exposure using forward rates? So these are the contracts you enter in. First of all, you should be able to determine the forward rate. So you have a spot rate. The spot rate is today's rate. If today's rate is 950, how do you determine the forward rate? You have a scenario here. Normally, how are the forward contracts quoted? You have a spot rate, whatever CHF is equal to 890 Rwandan francs, and the lower rate is when the bank is. So you need to know whether the bank is buying or whether the bank is selling. So this will be the selling rate. And can we get these notes at the end of this session? Yes. So for this case, be able, first of all, to interpret the spot rate. This is the selling rate, 903. This is the selling rate. So like if you come to the bank and you want to buy dollars, the bank will be selling dollars. For each dollar, you need to pay 903 Rwandan francs. But if you want to sell dollars yourself, if you take dollars to the bank will be giving you 897 for each $1. So always think what is the rate that favors the bank. That step number 1. If I'm buying or I'm selling, select the rate that favors the bank. If you want to buy dollars, where do you pay much? That's the rate. If you want to get dollars, where do you pay much? If you want to convert dollars and get Rwandan francs, where do you get less? That's the rate that should be applied. Now, so that's the spot rate. Now, what is the forward rate? See, here you have 1 month forward, you have 3 months forward. You should be able to identify when is the transaction happening. I'm expecting to receive dollars. When? In 1 month to come or in 3 months to come. If the transaction is happening in 3 months, ignore this second line, choose the 3 months forward rate. If the transaction is happening in 1 month, choose the 1 month forward rate. Number 3, now, how do I get the forward rate? There is a principle that you should, from the spot rate, you should subtract the premium or other discount. A forward rate could be quoted the premium of the spot or discount of the spot. So for this case, assuming the transaction is happening in 3 months, ignore the 1 month forward, take 897, subtract 4.5, and in most cases, this will be like in cents, okay? If it is in cents, if it's not in cents like this one, 4.5, if you take 897, subtract 4.5, you get 890 something, like 893.5. That will be the forward rate. So put 893.5 here, and 903 subtract 3.5, you get 900.2. So these are the 3 months forward rate. Now you have two rates. Which one to select? If the bank will be selling dollars to you, select the higher rate. The bank will sell you at a higher rate. Okay, you need to pay more. If the bank will be buying dollars from you, like in the case you receive dollars, you want to exchange, the bank will be giving you a lower rate. So the bank will be asking you a higher rate, the bank will be paying you a lower rate. So you select one rate. So once you have selected the correct rate, now determine how much are you going to pay. So make a conversion, you are either multiplying or dividing, or how much are you going to receive, whether you are using that forward rate you have selected. So basically, that's how you hedge foreign currency risk using forward contracts. It's just 3 steps. Now, how are you going to do the money market hedge? In most cases, this question will also come with a money market hedge. Then they ask you which hedging mechanism are you going to select. So determine how much will you be paying or receiving using the forward contract, then come and do a hedging using the money market. You'll be given different rates. So basically, instead of converting the currency at the forward rate, you can opt either to borrow now, deposit money, and earn interest, and be able to have funds you need to pay in 3 months. Or you can decide to borrow now, have money sitting in your account, pay associated interest, so that at the time of making a payment, that money is there. So that's how the money market hedge works. So I've written down different techniques you should use. Different techniques you should use to hedge a future receipt or hedge a future payment. I will encourage you to go through and read this. So basically, if you want to hedge a future receipt, determine how much are you going to receive. If you are going to receive $500, okay? Now, if you were to have that money now, if you borrow that money now, how much will be the present value? So you can borrow that money at the borrowing rate. Let me see if this is. So you can, if you borrow, how much can you borrow now? Okay. So that the present value of it is 500. Maybe you see the borrowing rate, the foreign borrowing rate is 10.7. I compute the present value of 500, maybe I get 300. So borrow that $300, convert them at the spot, maybe convert, you get 300,000 Rwandan francs, deposit that money into the deposit, the local market rate, and the future value you'll get after 3 months, that's the value of your future receipt. So you can do the same for hedging a future payment. These are the mechanism. So if you have these notes, I know you're allowed to take notes in your exam. You have these notes, you have mastered the process, you can apply these techniques and be able to make a hedging of a future payment or future receipt. Now, if it was a payment, you have how much will it be for using a money market hedge. You know how much it will cost you for hedging using forward contract. Decide which one is the lowest payment. If you need to make a payment, where do you make a lower payment? That's the appropriate hedging mechanism. If you are to receive a payment, where will you receive more? Is it through money market hedging or is it through forward contract hedging? So that's how you should tackle the Forex risk management using either forward contracts or money market hedge. Another interesting topic that is most examined, if it is not that money market hedge forward contract, it could be hedging interest rate. So for the money market and the contract, future contract is when you are hedging a receipt or a payment of an amount, a given amount in the future. For future rate agreement is when you intend to borrow or you intend to make a deposit and you have a concern that interest rate could go up. So if you have a case of borrowing and the concern that is the interest rate could go up, then you should use a future rate agreement. Again, is an agreement to fix the borrowing rate or the lending rate today for a borrowing that will come in the future. First of all, how should you know which rate to use? In most cases, future rate agreements are quoted like this: 3 versus 6, 3 versus 5, 3 versus 8. How do you interpret this? And then you are given two rates, 8.01, 7.91. So I'm going to show you how you interpret it. So 3 versus 6 means a transaction that is happening in 3 months time from now, and it will last for 6 months. An example, we expect to borrow, we are in November, we expect to borrow in January, and we repay the loan in July. We are in November now, 2020, we will borrow in January 2021, and we'll make a loan repayment in July 2021. If that is the case, that's how the future rate agreement will be quoted. 3 versus 6. A loan that will be taken in 3 months from now and will be repaid within 6 months from the time it is taken. 3 versus 8 means a loan that will be taken in 3 months from now and will be repaid in 8 months from the time it is taken, not 8 months from now. Now, so assuming the correct period is this one, 3 versus 6, what rate to consider? Always get a rate that is favoring the bank. So this, interpret this as 8.01% annual lending rate or deposit rate. So the higher rate is the lending, the lower rate is the deposit. If you get a loan, you pay 8.01%. If you deposit, you get 7.91%. So if you are borrowing, select the higher rate because the bank will be asking you to pay more. If you deposit, the bank will be paying you less. So the correct rate is 8.01%. Know that this is an annual rate, but look at the period, the loan will be there for 6 months. So you need to make an adjustment of whatever number you are computing when you are computing interest rate. So it will be interest rate using 80%, but for 6 months. So you know how you should make your adjustment. So now, how do you determine the effective borrowing rate? That will be the question that will be asked. So this is the mechanism. Remember, when the time happens in January, you will go and borrow, okay? So there will be a market rate. Maybe the borrowing rate is 10%. You need to pay 10% in interest. But what the future rate agreement does, you agreed that the lock-in rate is the future rate agreement. Let's say it was, this one, 8. Okay? So that means if you are paying more than what the rate you agreed is, the bank should compensate you. You pay at 10%, the bank will give you the difference. So there is a cost out of paying interest and there is a benefit of receiving some compensation. The net cost will be the difference. okay? Then the borrowing rate, the effective borrowing rate will be that net divided by the loan. You get the effective borrowing rate. So basically, that's how you do it. Compute the borrowing cost by taking into consideration the compensation received from or paid to the, and then remember to adjust the borrowing period. And also remember to gross up. So if you want to do a shortcut, how do you get the effective borrowing rate? You should take the future, if you take the future rate agreement and you add the margin, you'll get the same effective borrowing rate as if you do this computation. What do I mean? So what is the margin? Normally the lending rate, the other 10% I talked about, it will be determined as a reference rate plus a margin. A reference rate could be a treasury bond rate. So in the market, they'll say the lending rate is a fixed rate, which is, let's say, a treasury bond rate of 9% plus the margin. The margin will change, okay? I mean, sorry, the base rate will change, but the margin will be fixed. So, and the margin can be expressed as 100 basis points. So it can be expressed in the basis point. If they say 50 basis point, that means 0.5%, because 100 basis point is equal to 1%. So they say the lending rate is a reference rate plus a margin of 50 basis point. So if the base rate is 9.5%, the lending rate will be 9.5% plus 0.5%, which is 10%. Now, so when you want to compute the effective borrowing rate, you should take the future rate agreement, which is in this case 8.01, then plus the margin. If the margin is 0.5, you'll take 8.01 plus the margin, you'll get your effective borrowing rate. So in summary, that's how you should apply the future rate agreement. Working capital management. Let me pause to see if you have a question. Please let me know if you have a question. I'll pause for 5 minutes for questions. So I want to connect my laptop, so I'm going to stop sharing for a while, and then in about 2 minutes, I'll be back. Okay, so I'm back. No questions? Let me bring back the presentation. Can you see the presentation? Please let me know if you can see the presentation. Okay, good. So working capital management is another important topic to be covered. So how can you tackle the question on the working capital management? I think there was an earlier question that. So first of all, you should be able to compute the working capital cycle. The working capital cycle is the length of the money from the time you sell, from the time you pay to buy inventories, convert the inventories to finish the product, you sell, you receive either money in cash or others in receivables, from the time you pay your payables and the time you receive money from creditors. So how long does it take? That's the working capital cycle, okay? The longer the working capital, the bad it is. The lower the working capital cycle, the better it is, because the longer the working capital, you need to borrow money to finance your operations. So you can either finance your operations by collecting money quickly, or you can borrow. So if the working capital cycle extends, you need to borrow, and that will be a cost. So that's what you need to bear in mind. Here you have a formula of how you can compute the working capital cycle. The raw material inventory cycle, you know the formula. The inventory days, what we call the inventory days, you subtract the supplier days, the production cycle days, the finished good inventory days. So basically all these are the financial ratios. You know, inventory divided by the sales times 360 or whatever the formula is, customer days or receivable days. Then you have the working capital cycle. What is important is to check whether the cycle is increasing or reducing, and then devise ways of reducing the working capital cycle. You can reduce the working capital cycle by correcting RA, your trade receivables, but also know the implication, because what might happen is that customers may not be able, with the reduced credit period. The other way of thinking about it is also delaying to pay your customers, your suppliers. And if you delay to pay your suppliers, you know that this will have a negative impact. They may not be willing to supply to you. So all these are the factors you need to take into consideration. So basically, briefly, that's how you should be able to identify what should you do to manage your working capital cycle. Then the other topic you need to understand is to diagnose the overtrading or undercapitalization. What is on overtrading? Basically, a company is overtrading when it is punching above its weight. Like it's expanding rapidly, it's borrowing, but the assets are not expanding. Wait, what's going on? sorry. Is it okay now? So the overtrading is a situation where a company is expanding rapidly, aggressively, but without expanding the base, without investing too much, without investing enough to sustain that expansion. So there are certain ratios that are computed to be able to diagnose the overtrading. So you have a list of these ratios. You should be able to compute these ratios. Sharp increase in sales relative to assets that will be followed by declining margins, increase in inventory levels as a proportion of sales, increase in payable days. Trade receivables may be increased, but then reversed because you are quickly collecting money because you are expanding, but you don't have much capital needed, increase in short-term borrowings, worsening liquidity. So anytime you are asked the question to diagnose whether a company is overtrading, please note down these ratios and compute them. So you have information year 1, year 2, year 3, then be able to compute the ratio, these ratios that are here, and see whether there is increase in payable days, short-term borrowing increasing like that, and then to help you to decide whether the company is overtrading. Credit policy is also an important topic that is most examined. And when you are asked the question about a credit policy, is about a cost-benefit analysis. So be able to compute the benefits. Basically, what is a credit policy is a decision to extend the days you allow customers to pay. Maybe customers were paying in 60 days, then you want to give them additional 30 days to pay in 90 days. So it could be also a change in a discount. You want to give them more discount. So how do you decide whether the credit, the revised policy should be accepted or not? Again, it's a cost-benefit analysis. What are the costs? One, once you increase the receivable days, of course, more customers will buy. Okay, you increase the customer loyalty. You expect an increase in sales, but at the same time, trade receivable will also increase. When trade receivables increase, that means more money is tied up in receivables, and therefore you should borrow to replace that money. And the first cost is an increase in the interest. So you should be able to compute how much will be the new receivables with this credit policy, what is the change in receivables, and borrow that money at the bank lending rate. That will be your interest. That is the cost number one. Cost number two, there could be additional administration cost of managing more customers and etc. And another cost could be increase in bad debts. They could tell you if this policy is implemented, the bad debts will increase from, no, even if the rate doesn't increase, but if you take 1.5% times the new sales, because the sales will increase. As the sale increases, the bad debts also increase because bad debt is a percentage times the sales or a portion of receivables. So increase in bad debt is also a cost because you are likely to lose that money. So those are the costs of this policy. What are the benefits? It could be increase in annual contribution. So when sales increases, of course, associated cost will also increase. But when you take the change in sales revenue and change in the cost, you get the net increase in the margin or net increase in your contribution. So that figure could be given in an exam, or you could be given information to compute the net contribution, the contribution being price minus cost. So increase in the contribution is a benefit of the credit policy. Then financing the additional receivables, administration cost, increase in bad debt is a cost. Then compute the net gain, take the benefit minus cost. If the net gain is positive, you should recommend the credit policy to go ahead. If the net benefit is negative, the credit policy should not be accepted. Another thing could be debt factoring. And what is debt factoring? Debt factoring is when you hire a third person to collect debt on your behalf. It could be non-recourse factoring, it could be recourse factoring. A non-recourse factoring is when that third party is also responsible of bad debts. So you sell the receivables, and whoever pays, whoever doesn't pay, that is not your concern. He'll just give you all the amount, of course, deducting the administration fees and what. So if that happens, should you accept debt factoring or not? Again, it's a cost benefit analysis. What are the benefits? One, you avoid the bad debts if it is a non-recourse factor. So a percentage of credit sales that would have gone in bad debt is a benefit. You could save on administration cost. Okay? And then the factor could also agree to finance a portion of your receivables at a lower rate than what the bank was charging you. That will be an interest savings from a lower rate. So all these are the benefits. Add together those benefits and then deduct the cost of factoring. The factor will charge a percentage of the annual sales or annual credit sales. So now you have your benefits, you have the cost, make a sum, and you get the net benefits of factoring. So when the net benefit is positive, go for factoring. If not, don't recommend it. The same can be applied on offering discounts. So you could be asked to advise whether a discount of 5% should be given. When you go for discounts, receivables, customers will increase, okay? But it will reduce the receivables because they'll be prompted to make another payment to benefit for a discount. So the benefit saved is a reduction in receivables, and it is valued at the rate, the interest rate you would have paid if you go to borrow that money in the bank. Previously, for the receivables were 400,000. Now the receivables is 300,000 because customers have paid early. There is 100,000 you are gaining, and then the gain is the interest you would have borrowed that money from the bank. That will be the interest saved. And the cost will be the discount, of course. You are giving out 5% of credit sales will not be received because it will be given as discount. So that's the cost. So you take the credit sales times the percentage of the customer taking the discount, then times the discount rate, you'll get the cost. Then you do a cost benefit analysis, the benefits minus the cost. If the net benefit is positive, yes, go for discount. So basically, that's how we can tackle the question on the working capital management. Any question before I turn to the last two topics? Then I'll come back to the gearing and gearing question. Please type in your questions in the chat. I see no question. Performance management. So I let's think the performance management is one of the easier topics that should be tackled with simplicity, because someone who is at the level of an advanced paper in a CPA is well aware of different ratios. Okay, so you are given information, compute different ratios, liquidity ratios, gearing ratios, um, investors ratios, profitability ratios, whatever ratios are, and there are two ways of making interpretation. One, compare those ratios with industry average. So you'll be given financial information for the company, and then you'll be given the industry average. Compare the ratios relative to the ratios of the sector. That is one. Number two, you could be given a trend analysis. You are given information for year 1, year 2, year 3, year 5, year 4, things like that. Compute the ratios and see the trend. Is there increase or decrease? Is there improvement or the situation is deteriorating? Are liquidity improving or worsening? So that's how you should be able to interpret the ratios, either over time or in comparison with peer companies. And then look at ways of improving the performance. So if you ask a question of how can you improve the performance, look at the ingredients of the ratio. A ratio is a number divided by another number. If the ratio is low and you wanted a higher ratio, know that the numerator should go up. That's a simple mathematical way of interpreting what can you do to improve performance. If you should have a low ratio, like gearing level should be low, okay? Know that gearing level is the level of debt divided by total equity and debt. So you know that for a ratio to go down, a denominator should go up or a numerator should go down. Say, to improve the gearing levels, to lower them down, or either the debt should go down, reducing on borrowings, or injecting more equity. So that's the basic way of explaining or discussing the performance improvement. Play around the ratios, the number, it's just a fraction. Numerator divided by a denominator. Either increase the denominator, the ratio will go down, or increase a numerator, the ratio will go up. Then also scan the questions to see other areas where improvement could be done. Then lastly, normally question 4 or sometimes question 2 will be asking different topics, what I call sundry matters. Could be a question on corporate governance, could be a question on sources of finance, could be a question on dividend policy, could be a question on financial markets. Let me start with a dividend policy. The question is that, should the company pay dividend? Do dividends matter? Some could argue, yes, the dividend matters. Others argue the dividend payment of dividend doesn't matter. Why? So some says if the market is perfect, when you make an investment, you expect 2 gains. One is capital gain, the change in the asset price. The second is an income gain, which is the dividend. So people could argue, if you don't receive a dividend, the money will be reused as retained earnings to make more investment in a viable project, and then the value of the price will go up, then you will reap in capital gain. So it is compensated. And if you want money, cash flow, you can sell a portion of the price, the shares, and get your money. Therefore, it is irrelevant whether you are paid the dividend or not. But that assumes perfect markets and the low cost of transacting, low transaction cost, where you can easily sell your shares at a low cost. If the markets are not perfect or the transactions cost are very high, that theory will not apply. So all the conclusion is that some will be looking for higher income gain, higher dividends. Others will be looking for higher capital gains, change in share price. So they say the company should decide its own dividend policy and let investor adjust. If an investor doesn't want a dividend policy, he can sell the shares and go and buy shares somewhere else. So that's a theoretical part of it. Remember also dividends are also taxed. But now, how do you determine the dividend policy applied by the company? That's now a computational question. Very simple. Try to compute three things. So you may be given 3 different companies with an information over a span of 3 to 4 years. So how do you establish which dividend policy the company is pursuing? Either the company is be pursuing a policy of paying constant dividend or a constant dividend per share or a constant earning per share or a constant dividend payout ratio or just an erratic policy. Sometimes they pay a dividend, that time they don't pay a dividend, things like that. So that's what you need to come up with. So do they pay, is the dividend predictable? If it is earning per share, once I know the net earnings and I divide by the number of shares, I know the earning per share. If I multiply by the number of shares that I have, I know how much dividend I'll be getting. That's a constant dividend policy. So how do you do this? Just compute these 3 metrics. 1, try to compute the dividend paid, okay? And see if there is a constant dividend growth rate. Look at the dividend paid in year 1, dividend paid in year 2, dividend paid in year 3. Compute either the dividend per share, okay? See, is the dividend growing by 10% or a figure around that? If the dividend growth rate, if the dividend grew by 9% from year 1 to year 2, 9% from year 2 to year 3, 8.something% from year 3 to year 4, the company is following a constant dividend growth rate policy. That is one. Also, you can also compute the dividend payout ratio. So compute this for all companies. So you may see that another company is paying a constant dividend payout ratio. What is the dividend payout ratio? Is the dividend, okay? So it's the earnings. So you have earnings, you have the dividend. How much did they pay as a percentage of net earnings? So get the dividend divided by the net earnings. That's the dividend payout ratio. You may find that another company is always paying 80% of dividends. Company A, you may find that the dividend growth rate is constant. Company B, you may find out that each time they paid 80% of the net earnings. That's a constant dividend payout ratio. For another company, so just also take a dividend per share. For each company, compute the dividend growth rate, compute the dividend payout ratio, compute the dividend per share. Then observe. Another company may find that the dividend per share is constant. Maybe they are paying 3 Rwandan francs for each share. So best in a brief, that's how you should be able to tackle any question that is talking about the dividend policy. Corporate governance, scan the question, look at the board composition. Is board made of sufficient number of members that could form a committee? Is there a relationship, a familiarity threat between the members of the board? Are they related? are they related? So I'm trying to adjust the power. Are they related? Are they experienced? Look at the composition of the committees. Are committee composed with experienced people? Then look at the body selection and remuneration. How are they selected? Do they have a selection committee? Do they have a replacement mechanism? How are remuneration decided by an HR and a remuneration committee? What are the internal controls? The risk management. So those are the things you should look at, scan the narrative that I give in the question, and thinking about around those points, and then make an interpretation. Financial markets, very wide. You should just be able to differentiate a capital market, a financial market, a money market, sources of finance. What happens if I finance using a loan or equity, capital injections, venture capitalists, things like that. Corporate failures, reconstruction and business organizations, you should be able to diagnose whether the company is going to fail. There could be some signs, basically the financial ratio and the performance management should be able to help you. Reconstruction business organizations. So these will be like the narratives, the theoretical questions, where you need just to scan the environment and scan the question that is being given. There could also be any question on the effect of the pandemic on the economy, the integration. So really, no one can predict what will happen in the Sundry Matters, which in most cases in a question 4 or question 3. So basically, that's what I have for you. I would like to take some, we have around 17 minutes. I'm going to take a pause to get your questions. Please type in the question. I have 2 questions that I want to come back and answer, but as I'm answering the question, please type in the questions. Thank you. So good. So most of you would like to make a correction of past papers to see the hint. Yes, I understand your proposal, but to do that, you need more sessions. It's not something you can do in 3 hours. So whatever you're doing is the limit of the time that we have. Like correcting, so a question, past paper with 4 questions. It will take us approximately 4 hours, and we'll be only covering a few topics that may or may not come again. So there is a time constraint. So we have 13 minutes, and within 13 minutes, there is nothing we can do about it. Someone is asking when to meet again. That is a question for Stratton. So let me come back to the question of working capital management and dividend policy. Elvis Shema, I hope I answered your question. Please let me know if you have another question on that. A practical example on how to gear and gearing better. Yeah, I think I need to make a correction here. And geared better, and then geared better. Okay. Sandrine Gihozo, so I want to answer your question. So you have to use this formula. And for you to be able to use this formula, you first need to understand what this formula means. So when a company is solely financed by equity, it is called an geared company. And the beta of that company is called asset beta, BA, or ungeared beta. So in this formula, this is beta of a company that is solely financed by equity. That's BA. Now, when a company is financed by a combination of equity and debt, the beta of that company is called geared beta or equity beta. So it may be confusing, but please know that asset beta is beta for a company with no debt, and equity beta is a beta for a company financed by both and debt. So once you know this, you can, using this formula, you can either compute the beta of an ungeared company, ungeared company, this is the formula, or compute a beta of a geared company by extracting, Sivarurema, yes, please type in what you want. By, from this formula, you can get the equity beta. So equity beta will be equal to this one times this divided by this. Now, how do you apply it? So first of all, you need to understand what is asset beta, what is equity beta. Asset beta for a company with no debt, equity beta for a company with both debt and equity. So the situation will happen when you have a business investment in a sector A, and you know the equity beta, because let's say this business is financed by both equity and debt, the equity beta is 1.5. You want to go in a sector B, and you don't know the equity beta to use. But in sector B, you are given another company in that sector, but it has its own beta. So let's say the beta is equal to 2. Unfortunately, remember in a CAPAM, you need to have the cost of equity is equal to risk-free rate plus beta plus, so it's this beta we are looking for. What beta should you use? You cannot use the beta in industry A, though it's where you are, because by going in another industry, the risk level will change. Okay. Now, so how do you get the beta to apply when you go in industry B? So you'll get the beta of that company in industry B, which will be equity beta, let's say 2. You first assume what would happen, what would be the beta of that company if it was not if it didn't have any debt. That is beta A you are looking for, asset beta. So use this formula, take 2 of that company B times its equity and debt, apply it, you get its beta when it was not financed by debt. Okay, and of course you should get a value that is lower than 2. Maybe you get 1.2. That 1.2 is beta of any company in industry B that is all equity financed only. That's the beta you should use. However, remember, when you go and invest in a company in the industry B, you have a capital structure that you'll be using, maybe 80% versus 20%. Now the question comes, so we finished the engineering. Now, what is engineering? Now, say, if I have a beta of a company with no debt in the industry B is 1.2. How much would be a beta of the company in B if the capital structure was 70%, 20%, 30%? Now you come back and look, so you have beta A, now you come back and look for beta E. Beta E by using that capital structure of 70 to 30%. So because you have this, you can get the value of this one. So you look at beta E, maybe it will be 1.7. It is that 1.7 that you go and use in the capital asset pricing model. So that's how I can answer this question. Gihozo Sandrine, let me know if I have answered your question. Valence, can you give us a practical example of a merger and acquisition and forward exchange rate? Now, if you go back to I have a table here that shows the past papers. I'm quickly looking at the question that asked a merger. So the June question, the session of June 2016, question 3, had a question about business evaluation involving acquisition. And the techniques they used was to value the net benefits, the benefit you get if you acquire the company. So what's the cost of acquisition and how much are you going to gain? Okay, so I'm changing the computer. The first one is run out of the power. Can you hear me? Can you hear me? Yeah, so I got your questions, and the issue is the timing. I only have about 5 minutes left, and I can only do what I can do within the 5 minutes that is left. So an example of a forward exchange rate and fixed rate agreement. I'm scanning the. If you look at the June 2015, question 3, it asked the question of foreign exchange risk management and forward contracts and money market hedge. And even December 2016, question 3. But unfortunately, I'm not able to provide the answer here within 4 minutes that are remaining. So there is a constraint of the time. I have some of those answers I computed myself, but the timing is not. I don't know whether I can share them on the screen here. I have an Excel sheet that I'm trying to open. So I was talking about Missy question June 2015. Let me see. So it's, yeah, I have them here, but in 2 minutes that are left, presenting the case scenario and explaining what was the borrowing rate, the saving rate, the 6 months forward, and so it will be very difficult to explain. It's not that I don't have the answers, I have them. So as you can see, these are the Excel sheet I developed for most of the answers to all the questions that were asked. ICPAR doesn't have the official answers. These are my own answers, but time is not enough for me to go through all of this. So that's unfortunately with the time constraint, that's only what I can provide. So I have most of the unofficial answers, my answers, but within a minute that is remaining, I will not be able to explain them. So that's understand the challenge. So last words, we only have seconds. So okay, so it's time. I thank you very much for the time of taken. I understand your concern of solving some past papers, but within 3 hours, it is very difficult to discuss time management, structure of the paper, tips to tackle the important topics, and then solve questions. So it's very challenging, I understand. But what I can tell you is that if you use the principles I tackled there, you'd be able to respond to any question instead of just focusing on one, because one particular question can easily take us 3 hours. So within the time that I had, that's what I could offer. Um, and I wish you, Rake, in the exam, prepare well, take the principles and tactics and tips I've given you, practice as much as you can, and more importantly, time management is very important. So I thank you very much. Strato, over to you. Thank you.
Thank you so much, Deo Gracias, for good presentation. For advice to attendees, the past paper not come again. So the better way is to understand the principle behind every topic for strategic corporate finance. So you can do your work, you can make a research and practice all the question based on package or understanding from this presentation. So thank you so much for all attendees and thank you so much again, presenter Deo Gracias.
It is my pleasure. Thank you. And bye.
Okay, thank you. Bye.